Hi, I'm Adrian Strittmatter. Welcome to Bricks and More. I'm the CEO and co-founder of Centis, a global creative consultancy specializing in destinations, real estate, and the hospitality sector. Bricks and More is all about exploring how to generate, unlock, and maximize real estate value. Our mission is to challenge outdated and limiting notions of how this is done. In each episode, we talk to top professionals to uncover innovative strategies that drive short, medium, and long-term gains. So if you're passionate about making real estate more valuable for more people, you're in the right place. Welcome to Bricks and More. Real estate value creation is definitely evolving. Today, it's no longer just about buying well and selling even better. It's about innovation, operational intelligence, and creating assets that perform financially and socially. In this episode of Bricks and More, we explore how private equity discipline, venture-style innovation, and impact-led thinking are reshaping value-add real estate across Europe. From rent-to-own housing models to OpCo-PropCo strategies, this is a conversation about building resilient portfolios, unlocking overlooked demand, and future-proofing investments in an ever changing market. Today, I'm delighted to welcome Mathias Flattin, co-founder of Crayon Partners. Mathias brings a rare and powerful perspective to real estate. After spending over a decade as a venture capitalist, including building one of Europe's leading Proptech funds, he now applies that innovation-first mindset to institutional real estate investment. Through Crayon Partners, Mathias is pioneering pan-European value-add strategies that blend private equity discipline, operational innovation, and measurable social impact. From launching Crayon Jaune Fund to scaling OpCo-PropCo investment models, his work challenges traditional approaches to real estate, proving that strong returns and positive impact don't have to be mutually exclusive. Mathias joins us to unpack how value is really created when innovation, governance, and purpose properly align. So let's dive straight in. Mathias, welcome to Bricks and More.
Hello, Adrian. Thanks for having me today.
Absolute pleasure. We're always here to promote launches and new companies and new ventures. I have a sort of little personal question to kick off. You started in venture capital. You were active there for quite a while before moving into real estate. What sparked that transition?
I've always been keen to work in real estate, but I wanted to start with entrepreneurs. I was amazed by entrepreneurs. I value them a lot. The risk you take, the personal involvement, family, money as well, personal money. So I wanted to work with entrepreneurs for a start and do the private equity work of investing, backing them, trying to live what they are living on a daily basis and see the risk. And innovation is also about scalability, and I'm very excited about that, about thinking out of the box. And I progressively came with the idea that real estate may lack digitalization.
Yeah. It's a nice way of putting it.
Just a bit.
A little
when
bit,
I discovered these two statistics, 1% of productivity improvements a year on the past 20 years in real estate, in construction. So it means that there is no technology involved, while all the other sectors had progressed a lot.
Wow.
2, demographics. By 2050, 10 billion people on Earth. If everything continues like that, we never know, obviously. But how can we dwell all these people if we don't scale real estate, basically, and construction, and if we don't make all that more efficient? So in 2015, I started to meet some people from real estate, understand what we could do, understand why there was no startup in that field. In 2018, I started to commit with a team, my previous team, to work on one of the first funds in Europe to do property technologies. It was more advanced in the US, but as you know, Europe is always 3-5 years late in technology. It happens. And we launched that fund in 2020. So I was, from there, involved 100% on real estate technology. And this is how I met not my mother, but not your mother, but my partner, Thibaut Weston-Smith, pure product of institutional investments, real estate in private equity. And we decided to partner to launch the first real estate investor dedicated to innovative strategies called Crayon Partners.
And at your time when you were backing entrepreneurs, what is it that attracted you to become one? You said the sort of, the looking at what they were doing, but what is it that kind of got you and said, I want to sort of emulate that journey, or what is it that attracted you specifically to becoming an entrepreneur then?
It's the frustration of just being their board member at some
Nah,
point. When they succeed,
interesting.
they remember you were part of it, but it's their success. It's their risk,
Hmm.
100%. I was an employee at a private equity firm. It's very different. I started to be, I was a partner from 2020
Hmm.
on the Proptech fund, so I was involved. I wasn't an entrepreneur yet, but I was involved as a partner with the kind of the same risk,
Hmm.
later stage risk. But I think it was the frustration of, okay, I helped, I worked on it, but it's not my risk, my story,
Yeah.
my pride.
Instead of, well, involved versus being active in or fully active in.
Exactly,
Yeah.
100%.
And any traits that you say were common to all the people that you backed, that you worked with, that you helped?
Resiliency.
Ah, okay.
Only that. You can be smart, not smart. Some say you must not be too smart to be an entrepreneur
Mhm.
because you would think too much.
Mhm.
It's about not giving up,
Mhm.
putting everything you have at risk and not giving up, and also put as many options in front of you as possible, because in the end, one of them will succeed, and it's a matter of luck.
Yep.
You put all your work just to put as many options as possible in parallel. That's the amount of work, and then luckily one of them, one of the seeds will
Might
become
just work.
something, and
Yeah.
it's the launch of your venture.
And so, a very good transition actually, to the next question with regards to the gap in the market. You had all these options before formally launching Crayon Partners, all these options on the table. What was the gap in the market that created those options or dictated your choice as to which road you would go down?
It's a matter of people first.
Mhm.
Obviously, there is no team involving both skills, venture capital and real estate private equity, to my knowledge.
Mhm.
And with Thibaut, we were quite excited by that challenge. We don't. I say it all the time, but we don't dress the same way.
Mhm.
We don't think the same way, and we really value that.
Yeah.
That's really the core of our partnership.
Mhm.
And we thought, okay, real estate hasn't changed that much, and there are two sides if we want to bring innovation into real estate. It's by investing into real estate or bringing technology to real estate.
Mhm.
And with that positioning, backing innovative operators who invent new ways to operate, commercialize real estate, and to face the challenges, social
Yep.
challenges. That's really the main issue and the main trigger for us.
Mhm.
Maybe we can do something interesting by investing in new fields, creating profitable strategies that will be institutional tomorrow, and also bringing all these technologies, because if traditional real estate players don't want to use these technologies, to adopt
Mhm.
them, to take the risk, because the notion of risk in real estate is far different than in venture capital.
Yeah.
We should be the first ones, the early adopters of these technologies, to put them in our assets and have this operational efficiency brought by digital, now
Mm.
AI. That was the trigger, and that was the reason for us.
So kind of like a proof of concept, sort of proof of concept to make sure that then it works and then it could be scaled.
Yeah, exactly. We are right after the proof of concept, so we are
Mm.
the first scalable
Yeah.
opportunity for startup founders
Mm.
and for operators, founders.
Founders. You've got that, as you mentioned with Thibaut, your business partner. You've got what I'm going to call kind of like a successful dissonance in the terms of of being able to work together. Do you have a commonality or an agreed or sort of shared view on what and how you would define value in real estate today?
That's a good one. I think we see it. I don't want to talk for Thibaut, but we that's the reason of creating Crayon Partners. Basically, real estate is a very supply centric market.
Hmm.
I have this apartment. Do you want it? And by the way, you
build
must
it and they will come.
and they will come.
Yeah.
You build it and they will come because of demographics, because of. But this has changed. Now you can customize your shoes, you can customize your car, but not real estate. And switching from a supply-centric to a demand-centric market is a very big challenge for this industry, and yet it hasn't been done. It's always triggered by external factors. These changes, norms, environmental norms, market conditions, cycles,
COVID,
digitalization, everybody.
Exactly.
And I think we share the idea that if we want to do resilient real estate, interesting portfolios, we need to answer the needs of and understand the needs of the people that live, work, and play in them, and also try to understand that to link it with the social challenges that we are facing. People want to be nomads, still they want to be homeowners, and in multiple challenges.
Population's getting older.
Yeah, exactly. In France last week, for the first time, we, since school, we hear that there are the baby boomers. A lot of people, they will grow old someday, and someday they will need us, and we will have a problem. And for the first time, it happened last week. We had the official study in France, saying, okay, for the first time, there's been more dead people than newborn in France last year.
Wow.
And I mean, it happens. When you're taught that at school, it's like it's going to happen someday, but it's not real. Now it's real. So how do you take care about all these people with the minimum, with the most efficient means? And in all these social challenges and environmental as well, real estate has a place and
definitely.
A role.
Yeah, absolutely. And I think, what I find interesting is, Crayon Partners kind of position themselves at the intersection of innovation, impact, and performance. How do you, in response to, as you said, those social or economic or market challenges, how do you balance those three sort of in practice?
Hopefully, and the three are highly related, and impact should drive performance. It's not possible to imagine that when you do something that's impactful, it should bring less money. And that's the concept of impact investing, by the way. It's impact is a lever to produce more performance because you address a need. So when there's a need, there should be a market. If you're smart enough to address it with the right innovation, there should be a deep market. So those three concepts are highly related. On the past, it was called philanthropy. And this is where impact investing that came in 2010, something like that, was very disruptive. The concept that, okay, you're doing something good, but it should bring money as well.
And then, that's interesting, because I think in terms of where you're positioning yourself as impactful or sort of value add strategies, how are you feeling that the current sort of macro market and macro uncertainties, how do they kind of work together? How are you sort of mapping that out in the current context, which is anything but, let's call it mobile, for lack of a better word?
Uncertain. So first, there's always been some uncertainty. If you stop because of that, you will never create anything. Uncertainty can be a good risk. Regulatory risk can be a good risk as well. Either you take it or not, but it's an opportunity as well. The Uber and all the recent disruptive companies survived and were a huge success because of that. So uncertainty for us is a very good thing. But these challenges I was talking about, they have been known since the SDGs of the UN, the Sustainable Development Goals.
Exactly.
So it's not uncertain. The president of a country is uncertain. What he says is uncertain. But there's kind of an economic order, and there are some needs. So needs ensure that your market will be deep enough, and that's our bet. That's our bet. Maybe there will be a nuclear war or whatever, and all that will be wasted and done for nothing. But I mean, everything that we are doing today will be for nothing. So why not trying something that has a deep market and huge need?
Yeah, I think it's. I mean, it's more sociological, but I think it's super interesting about a market being uncertain versus a market being, and I haven't got the word in English, but like imprévisible in the sense that you are, I don't know if it's the black swan theory, but you've got, you're not in control. As you said, like the SDGs, they're clearly, those are things that are happening. You choose to address them early or not early is, up to business strategy or ability. But I think in the current market, there are things that kind of come in, or curveballs. But in your view, then, I think that's really interesting. There are some overriding elements which you, however uncertain or counterintuitive some things see, you do need to respond to those needs.
Yeah, and uncertainty also brings investors that are more demanding in terms of performance. And that's good, because if we want to launch new strategies, we must target double-digit IRR. And otherwise, you don't get those investors.
Those
They will
investors,
put
yeah.
money in more proven concepts.
Mm-hmm.
So, as we are lucky that those strategies we've selected bring double-digit IRR, it's the good time, because people who are uncertain are also uncertain with the traditional investment strategies. And
Yeah, completely.
at some point, the investors that we've gathered, the 30 investors that we've gathered in Crayon Jaune Fund, I think they are all looking for the same thing: diversification.
Mm-hmm.
They've done some office spaces. Won't judge.
Yeah.
I haven't been involved. I would have done the same if I was involved in real estate 10 years ago. But they have some office spaces. They are trying to do some residential, and it's complicated because scattered portfolios and all that. With us, they find something else, and also they find some meaning, additional meaning in their investments.
And I think that's really interesting. So, like, when you're selecting or trying to sort of unearth these opportunities, you've got to kind of that balance between what we were talking, sort of, that technological operational excellence, and then asset selection. How do you find the happy medium or the happy balance in terms of unearthing and then selecting, again, back to like individual business plans? Okay, which are the ones you go for?
The core values of real estate remain there in the analysis, and that's really the field of expertise of Thibaut, being an investor in the US, in Europe, in Africa as well, has taught him a lot of things, and the basis of analysis. On top of that, this demand-centric approach that I was talking about earlier is the additional factor. Okay, are people going to buy it? Does it make a difference compared with traditional value proposition? And this is where the not sociological, but really the startup strategy and method comes in, because you need to do some acquisition. For our rent-to-own strategy, for example, there are some listing platforms for rental real estate. There are some listing platforms for property for sale.
Yeah.
There is no rent-to-own listing platform. So you must learn how to find those prospects who are going to buy progressively with our scheme rent-to-own your assets. And this is where the startup layer comes in. You must adapt to switch to this demand-centric approach.
Going back to, so this is one of my sort of, or at the agency, one of our bugbears is really trying to, and especially in traditional sort of commercial real estate, you mentioned offices, to try and really get into sort of our clients' heads that it is about the user, it is about the client, it is about the tenant and their needs. Why do you think real estate has been so slow to take, sounds awful, take the consumer seriously? And I mean, I'm talking potentially more commercial real estate, but why do you think that shift has taken so long, where other markets are clearly, everything is, the client is king kind of thing?
I wouldn't rank conservatism rank one, but I think it's a matter of cycles, and also real estate is complicated. It's physical.
Yeah.
Startups, fintech, you need people with computers and a lot of work, but you don't need, you don't have the bricks bricks and more. You don't have this physical world. It takes time to build an asset. It's a complicated value chain with multiple stakeholders involved. And when you want to disrupt, by the way, you cannot disrupt this value chain. You just need to progressively change it, make it more efficient. You need to be accepted. It's also
that's true.
there's also kind of a closed ecosystem. You must. When I started in that field, somebody told me real estate is simple. Either you are from real estate or not. I was like, what does it mean?
What does that mean?
So stop with that disruption idea, whatever. You won't get to the land if you're too aggressive, too disruptive, if you're not part of the pack. And so really, the biggest challenge is how do you progressively make real estate change by being part of the pack, accepted, providing value, but also, as I heard a lot in real estate, don't eat the soup of the person next to you. You must help him have more soup, but you cannot eat his.
You can't eat his soup. That's a nice way. That's a nice way of putting it. In terms of, I really, and when we sort of have been discussing this for a while, I think that rent to own, I think is one, it sounds really good. I think two, as you mentioned, it responds to, something that we see in the press extremely, often with regards to people's access to real estate. It's too high, it doesn't work. There have been across Europe different governments that have tried to help, people purchase. How do you see that becoming, you were talking like the intersection of owning and renting. How do you see that developing as a concept?
To me, it's obvious. First, it's not even in the UK. It's global. This problem. Secondly, this rent then own model has been quite developed on the car industry, for example. It's true. I think it's nearly. It must be nearly 50% of the cars that are sold that are through this progressive model, and also it's a matter of generation. I could give you 100 data points about what's happening, but the biggest one to me is roughly in every capital city in Europe, in Western Europe, from what I know. The amount of the proportion of first-time buyers in real estate acquisition has decreased by 25 to 35% on the past 15 years.
Jeez.
So that's what happened.
That's a big drop.
We like 40 to 50% were first-time buyers depending on the city in Western Europe, and we are now at 25, 30, maybe 35%. So it shows that. Maybe it's because of the baby boomers, so sorry for them. But also, it shows that there's a big generational problem. And I remember my parents telling me, we bought our house, we had a loan, 15 years loan. We paid 18% rate.
The numbers are...
every year. And now we borrow on 25 years and with 4%, so it's nothing. So what happened? So that it takes from 6 years gross revenue to pay your apartment to now 14 years average. What happened in barely 15 to 20 years? And what happened is the wages haven't increased as much as the prices of real estate because of the inefficiency of real estate, because the margins have decreased, the costs have increased norms, lack of productivity compared with other sectors. Real estate is late. And prices of real estate increased by 2x to 3x faster than the wages in the past 15 years. That's what happened. So now what's the solution? Bringing efficiency back to real estate, reinventing the models. And sometimes, unfortunately, if there are too many stakeholders in the value chain, you try to recreate a new value chain or a new portion of value chain to rethink the blocks, reposition the blocks, and add the efficiency, the digital and AI now efficiency into the each step to ensure that in the end you have a better margin, or you can lower the price, or you can increase accessibility. So rent to own is about affordability.
Yeah, and I think I was thinking about the car industry, but we also have it you also have it in the recruitment agency or the recruitment sort of an HR where you go, okay, you start with a temp or freelance contract and it's temp to perm. So it's kind of that sort of, well, it follows the journey, it follows the level of commitment and the structure of ownership. How does, with that model of rent to own, how did your investors react to it? How did you sort of create the model to show that if we go down this route, it will increase sort of overall attractivity and value, as you were saying?
I think if there are our investors, they love it, but prospect investors love it as well.
Mm-hmm.
What they need to see then is the risk mitigators.
Mm-hmm.
So okay, that's a good idea. People rent, then they can convert their rent into a deposit if they exercise their purchase option in 2 or 3 years. How do you make money?
Mm-hmm.
And why do you make more money than a traditional buy-to-rent strategy?
Yeah,
basically.
exactly.
At the core of this value proposition, there is something that we've experienced with the seed portfolio in the UK before launching the fund. It's the fact that, so first, our worst case scenario is buy to rent, basically. But in today's market, if we buy at a good price and we buy blocks, so of course we negotiate prices, we negotiate interesting discounts. You start at the right level to ensure that you will make performance anyways in your buy to rent worst case. Then on top of that, what you have is these people are our clients, rent to own clients. They are not tenants. Yes, they start by being tenants. They have an AST in the US, in the UK, short total tenancy, but they've experienced the pathway to become homeowners. Sometimes they've experienced mortgage refusals, and you know how the credit score is tough in the UK. You always fight against that score that banks are giving you, depending on your history. If you're young professionals, not possible. If you're a freelancer, like 1/3 of the freelancer don't want to ask for a mortgage. That's a statistic because they fear and that they will experience a refusal. These people have gone through the pathway of becoming homeowners, so they are seriously behaving like homeowners. When they are in their assets, they are responsible of maintaining the assets.
Maintaining the asset.
So of course it improves our margin, but bear in mind that when you buy with a 25-year loan, you're not the homeowner as well.
As well.
It's the bank. It's the bank, and still you maintain the house.
Yeah, exactly.
In our case, it's the same, and they care about the assets. They will not move in, move out every 18 months. That's the average turnover in big cities. They will do some paintings, and what we've seen and experienced in the seed portfolio is they also renovate, decorate. They put a heat pump with their own money. How often have you seen a tenant putting a heat pump in your house? It never happens. So starting from this worst case scenario, we buy good buy to rent in the current market conditions. You have on top of that some additional value creation levers that are very interesting, thanks to the behavior of the tenants.
And I find that super interesting. I mean, obviously, I grew up in Switzerland, which is, really a massive rental market where people do behave in that way, where access to sort of home ownership is not as frequent for various reasons, and people do take care of their assets. On this rent to own, what would you say the demographics are of people? You see, they've gone on this journey, they've experienced or had well, not necessarily a good experience, but they're sort of willing to try another avenue which you're offering. But what is the demographic? What is the type of person from an age perspective? I mean, what would be the profile?
Three persona. The young professionals. They lack credit history to have a decent credit score and borrow money, and they need 3 years. So that's exactly the contract length that we're proposing. Freelancers. Irregular revenue, uncertainty, as you said. These people have 3 years to prepare their credit score, improve their deposits, and by converting part or everything of the rent, if you exercise your purchase option, it means that roughly you will have accumulated 90% to 100% of your deposits.
But what's good is that you're, in essence, you're running the credit rating in that instance. You're sort of
Yeah.
you're in their books. You're seeing, good freelancer, bad freelancer. So that's really interesting.
Exactly.
Yeah.
That's
Sorry,
why
I interrupted you. Second point.
No,
Yeah.
problem. That's why the tech is important. It's about open banking. It's about assessing through AI. Sorry to use the buzzword.
No.
It's a bit tiring. But
What's he talking about?
AI.
AI.
You're able to automatically assess how reliable these people are, and if they have some weird bad habits in terms of expense, and you, not only you notice them, but also you help them trying to solve it. Okay, you point them out that this
That's not a good behavior.
this behavior will not be taken the good way by the banks while they study a mortgage. That being said, the third buyers persona are the key workers, those people that we are very happy that they live close to us in the city centers, like doctors, nurses, policemen, firemen. If they don't live 1 hour, 1 hour and a half.
Well, school teachers, everyone.
School teachers, exactly.
Everyone that was clapped during COVID. Yeah.
These people have a very certain revenue, but they need the deposits. And with us, they have 2 to 3 years to create these deposits, aggregate this deposit, but still they are living in the house of their dream. They can start their life and they know that they are not wasting money in a lease, in an apartment that's going to be more and more expensive over time, every year.
Wow. Yeah.
Talking about 15% a year in London.
That's crazy.
Sometimes even more. So that's the persona we target.
That's really interesting. I think and immediately, I think that ability to have ownership, that new pathway, and also for you to be able to offer that to those, as you said, those 3 personas, I think is really strong and helps. I think what I like then is the sociological level of how real estate and those kind of elements can help. Can help the mixity of cities as well. Otherwise, they'll become very sort of sterile or one type. In terms of Crayon Jaune. So the launching, we talked about the seed. What was the specific idea behind the inception of that, that sort of fund?
When we launched Crayon Partners, we had 6 verticals in mind that we wanted to address. I'm talking about innovative investment strategies, including rent-to-own, obviously. And quickly we saw that we had experienced rent-to-own ourselves. For me, as a VC, for example, I invested in a rent-to-own company. And I was aware of what was happening, but also with the rise of interest rates in 22, which is quite recent, we saw that this affordability question had become a very, very big issue. Because not only the systemic factors were there, but also some conjunctural, sorry, how to put that, some specific factors. That's what I want to say. Some specific factors were added to the systemic factors with the rates, and that becoming a homeowner had become impossible.
I was going to say more complicated,
but focus on this strategy, but also we tried. We tested the appetency of investors, and luckily, residential investment is quite complicated for investors. You address scattered portfolios. It's not as block investment as it could be with office spaces. So you need a middleman. You need an operator, a smart operator, to address these scattered portfolios with technology as well, to maintain it, to be aware of, to gather the data about your portfolio and make efficient investment as well. So this is where the OpCo-PropCo play, which is our DNA, has a role. Basically, if you want to do some good residential investment and address the need of investors to diversify more into residential, you need a new strategy, but also a middleman, a smart team, very local, able to maintain these assets that are scattered. And you cannot do the block way like we did with office direct investments on a block and a local operator.
And then what would you say in your sort of, when you launched the fund, what was the response to it?
It's entrepreneurship, so of course it's not easy. As I said, we've put a lot of options in parallel. We've met a lot of people. we were lucky to, after 15 years each of experience in investments, to have a lot of people around us helping, introducing us to the right persons. We also, from day one, made I think the wisest choice to create that fund in Luxembourg, because Luxembourg is highly neutral. There is very few low uncertainty in its tax policy and all that, and that's why it's managing, I think, roughly 25-30% of the funds, Luxembourg, because of that stability. So we created the fund in Luxembourg. It's a RIFE, reserved fund for professional investors and institutionals. That was also a very good choice. So I think, based on our experience, we found some ways to bypass some difficulties. But of course, it was tough in the current context where nobody is raising funds. But we managed to do so. We managed to very successfully to do so, and we are here with that fund, deploying in the UK first, and then we'll see.
And is there anything in the UK market that you've been surprised by in terms of sort of deploying the desire or deploying the capital?
So luckily, my partner Thibaut Weston Smith is British, so I think he was surprised of nothing.
You were on more of a journey.
I was the French, the French, discovering more and more the market, even though I was involved in that rent-to-own company in the UK for a while. But I think what I saw with that market is the unlimited demographic projections that there are, and we don't build enough in London, but also in the rest of the UK. There is the same affordability issue in the rest of the UK, by the way. It's not only London, Paris, Madrid. It's also secondary cities. We try to address London because it's more comfortable for our investors to think that they have their own assets in London. Okay, that's okay. But the demographics are so deep and so interesting. There is a lack of 500,000 units in the UK. In London, it's a majority of
a big
that,
chunk of that,
of that amount. So we know that London is the right place to start, also because of that. And I think I discovered that in a way because London seems huge. London is expensive, but still there's a huge demand. And our goal is just that: there is an offer that is struggling to sell, and there is a demand which is not able to borrow money. So we create a new demand by helping people. We basically cherry pick, we select the best borrowers of the next 2 or 3 years before they are able to borrow. And we tell them, okay, we have an apartment for you. You can commit with us. You don't commit that much. It's a purchase option. But when you will be ready, and we will coach you, we will help you to be ready. You will be a good borrower with the best behavior, very reliable. And we've created with rent-to-own. Rent-to-own creates this demand. But like the car industry, would you buy a brand new car? No. So you take this progressive model, and you have a brand new car that you would have never bought anyways.
Yeah, if you hadn't gone through that, exactly. Gone through that process. Do you see this becoming more, as it takes on, more mainstream in Europe as being,
I think
pathway?
We are still at the early phase. And before that, and before the rates rose, we were really at the prehistoric phase. A lot of operators, not all of them survived. And what's happening now is
why?
Because it's very hard to get real estate money, equity. That's the purpose of that's the raison d'être of Crayon Partners.
Of the fund,
you need a third party. You don't. If you're an investor, you don't want to give the money to the operator himself. You know that there's going to be some conflict of interest. So you need professional private equity investors to deal with this money, understanding the market and the operator,
and
but
the
also
allocations.
Being very close from the operator. We sit at their board. We are involved. We don't tell them what to do, but we want to be aware of how they are.
Yeah, of course.
How their success, their failures, what their learnings.
Well, they're the ear to the market as well, or as you were mentioning around, client, tenant, future homeowner behaviors.
Exactly. But also ensure and guarantee our investors in a way that these people are reliable, that they have cash to face the next years, that they are successful. And if you just provide real estate equity without being involved, close to them, being in a really partnership, a real partnership, you cannot create this trust.
I think what's super interesting about it as well is about the profiling or the credit profiling you're going to be able to do through this process. And at scale, that data could be hugely valuable because you're basically giving parameters to say these kind of people will be in this situation in 2-3 years, which would be, in terms of future investing, a really interesting sort of data set, which would change from the classical ways of doing, credit ratings or so on and so forth, because it's kind of looking into the future. In terms of selecting the assets, of saying, okay, this one would work really well for this model of rent to own. How do you, obviously you've got, a market as vast as London. Where do you, what would be your kind of, your checklist to go, yeah, it's worth us looking at this?
The buy box. Just to come back on the first part of your question, remark. I think, as you put it, we try to analyze people out of the banking grid.
Yeah, exactly.
Right before, and think like creating a new banking grid. I invested in the past in a company called Guarantee in France on the rental market. They provide rent insurance, and they are the same basically. They don't need you to have a full-time contract. They don't need you to make 3x the amount of the rent. They analyze through open banking your behavior, and they find weak signals to understand if you're a good or a bad tenant in a way in your behavior. I remember an amazing example. They found out that if you have 2,000 euros on your saving account, you will be a good tenant. And 2,000 is nothing. It's barely a month of rent in the UK and 2 months in Paris. But these weak signals are not analyzed by banks with the traditional grid or old-fashioned grid. And this is where tech can help us, and that's what we are doing with rent to own as well. Is asking people, okay, you're out of the banking grid. So the only way for us to help you is, okay, you need to provide us with more information.
Yeah, cool.
And we will tell you if you're, in the end, in our view, a good or a bad borrower. And we can select you through that. So we know it's about privacy. We care a lot about GDPR or privacy. And for example, as investor, we don't have full access to this data. It's only the operator. It's very important, legally speaking. But we think out of the banking grid.
Yeah.
Coming back to the buy box of our assets, luckily, first-time buyers don't want to purchase prime residential in London. Most of them.
Yeah.
They want to be in zones 2 to 5 London for the revenue deciles we are targeting 3 to 7. People who are not in social housing versus people who don't need us. But 7 revenue decile number 7. So we target these zones. London also have a very efficient tube network. The Elizabeth line is amazing, and this is where we've done our free block acquisitions, first 3 acquisitions
on the line.
On the line, and it's very impressive when, like me, I've been in the center, but not in these areas. In 15 minutes, you're in the center.
Crazy.
You're in Bond Street. You're in Tottenham Court. So that's very efficient for that. We target newly built assets as well. We find very interesting, very, very smart real estate developers who tell us, okay, that model is amazing. We know that if we sell our own assets through rent to own, we won't do it the best way. We will sell the last assets that nobody wants.
Exactly.
So the good thing is Crayon Partners is on the buy side. We cherry pick the assets we want. We would love to buy. Our tenants would love to buy. So we buy good assets. We build interesting portfolios, and basically it's from one bed to 3 beds, because that's what a young household needs generally.
And are there a lot of opportunities out there to buy at the moment?
At the moment, a lot, because there's been a lot of projects developed, and again, there is a very deep need. So developed projects, there's a big choice. We have a qualified pipeline of 500 million as of now, and it's growing. We are visiting every day new projects. Then we can buy assets ahead of their building.
Ahead of their completion date.
Of their completion.
Okay.
But we don't want to do that as of now, because we want to complete the feedback loop, the loop, as early as possible. So we want people to move in right now. And with the first closing of the fund this last summer, we already have some tenants living in their apartments. I mean, during Christmas, they spent Christmas in their apartments. So it was very rewarding for us.
That is a good sign.
And very, very important as well to show that the model is already up and running.
If you were to sort of to close off, do you see, or what would you think is one of the most sort of underestimated lever of generating or unlocking value in real estate today?
There's construction and real estate, right? So if you tell me construction, we've done nothing in offsite construction, and this is where the biggest lever is. And then it's about reorganizing this value chain by putting the right tools and maybe changing the place of the stakeholders amongst them.
Okay. Yeah.
For real estate, I would say it's really this demand-centric approach. At some point, we have no excuse. We have all the tools. Everything, all the tools already exist. All the data points are here. Okay, you need to pay a subscription, but you can improve all your processes, and you can augment all your employees with AI now. It's only been 3 years. It's very recent, but it's there, and it's kicking. And for real estate, it's really about operating, to me, and switching to using these tools that already exist and haven't been adopted that much. That's why a lot of Proptechs have died, because Proptech is on, startup is on the short-term view, and real estate, as you said, is on the long-term
view. Yeah.
So the ones who survived are going to be huge success, and players in real estate who are not using these technologies, I think they are missing something, and I don't think they will be there in 10 years. Some of them haven't seen the environmental norms coming, and now the AI and all that. You should rethink. The only problem is human. What do you do with your teams? Do you reorganize? Do you continue hiring people? Do you fire? And that's the biggest challenge. But I think all real estate companies should hire a consultancy firm, not the ones using human, but the most efficient, to understand how they will improve their process and adapt, because it's a tsunami.
And is there sort of, you're talking to, investors, looking at projects and talking to investors on a daily basis, and like one final question from me, is there any sort of myth you'd like to say that you hear often and often that comes back that you'd like to put the record straight and say it's definitely an urban myth, or it's an investor myth, it doesn't exist?
Oh, the myth in real estate? It's really hard, because
there might be many.
The myth is the fact that nobody has any ego and everybody wants to develop. I think everybody has an ego, otherwise we wouldn't do that. We would be careful and employee and have some good view on our salary. But still, I think it's a myth, because everybody is passionate in real estate, and everybody loves bricks. I mean, everybody is excited. All the people, also the institutionals, the big ones. Everybody is excited by a visit, by a tour, an asset tour. The product is very sexy. And after doing, I've done VC for a while. Sometimes it's hard to project yourself on a pitch deck and some smart people telling you that the product is this and this. With real estate, you have no excuse. You have something beautiful.
Yeah. But it's deeply human at the end of the day. Exactly. It's one of the fundamental needs.
It's really human. Yeah. And so I think more and more this myth that I had about people with ego in real estate and in business in general is living for the idea that we are all doing something very exciting, and that has a role in any sector, any segment of life. If you talk about care, senior care, real estate has a role. If you talk about affordability, real estate has a role. Renewable energies, AI with data centers. So it's a very rewarding scheme, and we sometimes oppose real economy with real estate. In a way, when you have that kind of role, you must be part of the real economy, and you cannot consider that you're not part of the real economy. When you put money in real estate, you should put money in something that's going to be useful for the new uses, for future challenges, and I think that's what we want to do with Thibaut. We want to address these challenges because we think that it's building resilient portfolios, and in the end, we are in the real estate, in the real economy.
In the real economy, and answering to real problems as well.
Exactly.
And real challenges. Mathias, that was an amazing conclusion. Thanks ever so much for being on the show. It's been an absolute pleasure.
It's a pleasure.
Well, all success with Crayon Partners and all the funds.
Thanks very much, and congrats for Sentis as well. We are amazed by your global skills and your global view on real estate. We know that real estate is very hyper-local, and it's hard for a team to be cross-border like you are. So congrats as well as an entrepreneur.
Thank you very much. And when you get recognized in airports, you know that you've been traveling too much. But yeah.
Soon.
Excellent. Thank you, Mathias.
Thanks, Adrian.
Ciao.
Thanks for listening to Bricks and More. If you've enjoyed today's episode, please share it with a colleague or friend who would appreciate it. If you're not already, connect with me on LinkedIn, whether to say hello or discuss a destination, real estate, or hospitality project of your own. Finally, please rate the podcast on Apple, Spotify, or wherever you get your podcasts. Again, share the episode, connect with me on LinkedIn, and rate the podcast. I'm Adrian Strittmatter, and I'll be back soon with the next episode.